Joining us now, Jason Trennert, CEO and Chief Investment Strategist of Strategas, a Baird company. Jason, great to see you as always. Before we get to today's bounce, let's talk about yesterday's sell-off. What was the cause for that in your eyes? China, yields, DC?
You know, Wolf, I think it's a combination of all those things. To me, the most important change over the last week has largely been the announcement that the Fed is going to start tapering, that the Bank of England is going to start tapering, is that the Bank of Norway, Hungary, Pakistan. There's a lot of central banks around the world that, at the margin, it's very much at the beginning stages, are just changing their policy on monetary policy, and I think that's probably the single most important thing. It's not to say that was the focus of what was going on yesterday. There were a lot of other things to worry about, including the drama surrounding the Fed, as well as the budget negotiations. But to me, the most important thing to watch is central banking.
So do you think yields have got further to rise, or will we pause here? And what does that mean for equities?
Well, my own opinion is that it's still hard to kind of fathom the idea that you have inflation that's running, let's just say, at 5%, and you're getting a negative real return of 3.5%. So now that hasn't been a particularly great rule of thumb in terms of trading bonds. So for a long time, you still have $13 trillion of negative yielding sovereign debt around the world. But to answer your question directly, I think rates are headed higher because I think inflation is stickier. I do think that presents some problems for the growthier parts of the market. Again, it doesn't have to be a disaster. It's not like switching on and off a light switch. But I still am largely of the view that value stocks are going to outperform growth for the most part, as rates normalize and as the global economy starts to normalize as well.
I think of you as a Fed watcher a bit, Jason. Can you believe this drama around, first of all, Fed Chair Jay Powell and Senator Elizabeth Warren calling him a dangerous man, two regional Fed presidents resigning early on the same day, and expirations coming from a number of other governors, including the vice chair for supervision and the vice chair of the Federal Reserve.
Right.
That seems like a lot of uncertainty. How does that play out in your mind?
Yeah, no, Sarah, you're very kind. We have a genuine Fed watcher in our shop by the name of John Rissmiller, but I'm kind of an amateur watcher. I've been doing this for 30 years, and I've never seen anything like this, and have studied this quite a bit, and it makes me a bit nervous, I have to say, because I believe the Fed, and this is warranted, I think the Fed has among the best reputations of any government agency in Washington, D.C., largely because they stay out of politics and they generally try to do the right thing. This does have a little bit of an element of a purge to it. I don't think it's any coincidence that some of these things are happening during the negotiations for the fiscal stimulus package. And it is a little bit concerning or disconcerting that people would use the central bank in that way. And I'm not casting aspersions on anyone in particular. It seems like more than a coincidence that these things are happening at the same time. I'm friendly with some of the people on the FOMC who I think are wonderful people. But I would hate to see the Fed become overtly political, because I think that really risks real damage to our financial markets or capital markets. Jay Powell is about as dovish as you can get without damaging confidence in the central bank. Without him, they better have a very good replacement. I would just say that, or you're going to have, I think you're going to complicate things. The administration might complicate things for itself.
But Jason, I mean, what could they appoint? I mean, they're not going to appoint a load of hawks, are they? So how will it drastically change the outlook for equity markets?
No, I mean, as I said, Jay Powell is about as dovish as you can get. I do think there are going to be significant changes in terms of bank regulation, with Randy Quarles leaving and Rich Clyard leaving. I think you're going to have people that are obviously somewhat more progressive. I think what you don't want is diversity of thought, and I don't think you want a situation where everyone thinks the same way on the Federal Reserve. And that's what worries me when you have all these potential changes where, it could seem as if you're stacking the central bank. And you don't want that, it seems to me. Not as someone who participates in the financial markets myself and runs a brokerage firm. I want a straight shot at it. And again, I don't want to make it overly dramatic, but it is. I mean, for the Federal Reserve, this is about as dramatic as it gets, right? This is soap opera type stuff, and we have enough soap opera stuff going on in the rest of Washington D.C. And it seems to me we would rather avoid that in our own central bank if we could.
Probably for the best. Jason, thank you. We'll leave it there. Jason Trennert from Strategas.